Hello, everybody. Hello, investors, friends, business partners. As usual, we do our bi-weekly CIO meeting call where we discuss with our CIO recent developments in the world on the financial markets and in the macrosphere. We have here founding members of Blackfort, Oleg Falikovic, managing partner, me, Gleb Stripe, our CIO, Dr. Andreas Bickel, our equity specialist, Simon Meyer, our head business development Europe, Ivan Gerber, and head business development Eastern Europe, Arseny Volinov. Missing today is our head business development Central Asia, Emir Sembinov. We will start, and I will hand over to Andreas Bickel. In the end, we will have a question round where our specialist and ourselves will pose some question on the macro situation or on the current situation on the financial markets. And yes, Andreas, I would like to hand over to you then.
So thank you, Gleb, for the introduction remarks. Let me share with you my screen and presentation. Okay. Today's market call is going to cover these topics. So basically, I will talk you through some of the unconventional measures by central banks and by different governments. There are some scenarios on the economic side. What will be that kind of for the investment market, where we see value in the corporate side, some introduction or some overview of equity markets, some interesting insight of winners in Europe. I just have found this acronym today, granola. We will find out later what that will mean. And last but not least, we had talked 2 weeks ago about the Russell, that it might outperform, and actually over the last 2 weeks it really has, maybe for the wrong reasons, but the point is it really had what we anticipated or expected. So let me start. We have unconventional times due to a pandemic. However, we have unconventional measurements which we haven't seen before, and hopefully we won't see for the next 50 years once this is over. What do I mean by that? The ECB and the Fed both have decided that they buy fallen angels. It's a nice expression, but basically what it means, they are going to buy bonds which were in March still investment grade and now are high yield. Or bluntly said, these bonds used to have the name 10, 15 years ago like junk bonds. So something unthinkable some years ago is going to happen. Similar, the Fed said, we are going actually to buy US high yields, not directly because that's forbidden. However, they will buy ETFs, so they will buy the broad US high yield market. On top of it, unthinkable some weeks ago, the Fed is providing with some twist and help from BlackRock and the finance department credits and guarantees and loans to smaller and mid-sized enterprises. Once, a long time ago, I learned about an experiment, a thinking experiment called helicopter money. Never did I thought I will ever talk about it in real life. However, Hong Kong, Singapore, and Macau have implemented a kind of helicopter money, followed by the US and Japan. To be fair, helicopter money would be directly paid out from central banks, and in all these cases, the money was paid out of the state budget, but the economical effect is very similar. Basically, you get unconventional income stream from the state in order to consume. In case of Singapore and Macau, these were vouchers and they had a purpose. So in Macau, for instance, you could only buy food with it. The fiscal stimulus in some countries range between 10 and almost 20% of their GDP. Global aggregated, we have reached 9% before the European Union announced last Friday that they will implement a 1.5 trillion euro helping or reconstruction program for Southern Europe. They are not going to implement Corona bonds or Euro bonds, but they are going to help with credits and direct aid and with the European saving mechanism. This would be an additional 10% of the total Eurozone GDP. This is tremendous, and obviously the global announced fiscal stimulus would probably reach somewhere an area of above 10 to 11%. Last but not least, Japan does for a while a yield curve control, where they try to keep the 10-year around zero, the yield of the 10-year government bond. Australia has announced the same. Last week, Fed has discussed it as well. So far, they will not implement it. And yesterday, the announcement was crystal clear that the negative yield is not going to happen. However, if markets continue to move the way they are moving, they might be forced to do as well a yield curve control. Underneath, you see some of the icons and summary of all the fiscal stimulus. Although this was recently taken, it's actually already outdated because, for instance, the European 1.5 trillion is missing. Unconventional times means also that the central banks have reacted much faster than during the global financial crisis. When this chart was produced, we had 69 rate cuts during the last 3 months, almost reaching the level of the global financial crisis. More interesting is the chart on the left-hand side here. It shows from the G4 central banks, so the Fed, the ECB, the Bank of England, and the Bank of Japan, the government bond purchasing program. So it excludes all the other measures the ECB or the Fed have implemented. And for the first time since this chart was produced and since the financial crisis, we see a global synchronized buying of government bonds. The politician and obviously the central banks are in a whatever it takes mode. And this has tremendous impact on markets, how they behave and what they anticipate. The outlook for the world economy is that Q1 GDP will be slightly negative, Q2 will be tremendously negative. Tremendously means somewhere between 7 and 15%, but in H2 we'll see a recovery. The question is how strong this recovery will be. The answer probably is nobody can know. There are some scenarios to be considered, but all for this depends how we get out of the lockdown. Here you see kind of overview where we stand in the lockdown or in the relaxation of the lockdown. You see that China and Korea at the forefront, and the US, which has announced a lot of different measurements, is still at the end of the pack. So we could argue that the opening up of the US might be too early. In Bosnia, for instance, yesterday there was a statistic, they opened up, not shown here, but 2 weeks later, the amount of new infected people has risen dramatically. So all will depend if the open up and the hygiene measurements will be followed or not. With that, you have 3 possible scenarios. I'm at the camp that I would say we will see a combination of the first and the third one. The first is what markets, or at least equity markets, price in, a V-shaped fast recovery in the second half of the year. The third, however, is a kind of overheating and midterm, maybe even inflation pressures or asset price pressure on various areas. And the one in the middle is we will have a stop and go. So these relaxation measurements had to be taken back in the future, and we will have a second lockdown due to the strong second wave. What is important, I mean, all virologists, all experts in this field, they tell you we cannot foresee, we cannot really know. But if you talk to people who, like us, and especially investment bank economists, they all talk of we are going to open up, V-shape, and there's a lot of political pressure to open up much faster due to the sharp impact on growth. The question obviously is then, where is the best money or value for your money? And given all these measurements, given that the Fed has announced further stimulus, yesterday the speech of Mr. Powell was for the first time really a great speech. It was well received by community and also in the social media. They are doing whatever it takes, and they have more poison pills in their wardrobe to help the economy. Therefore, for similar risks, as you can see here, these are the high yield spreads of the US orange and of emerging markets in green, of global in kind of blue. We are at similar level if we look at an option adjusted spread, but I would strongly argue that you get the best value in US high yields, followed by US equities. US equities have risen tremendously, therefore risk return adjusted, I would definitely prefer high yields from the US at the moment. A bit controversial, we have seen that in the C bond seminar. We prefer Asian corporates, in particular China. The reasons I will show you in a second. One thing is emerging market corporates selectively should profit. Why? Because everybody expects the US dollar to weaken. What is remarkable at the moment, we don't recommend to invest in government bonds, and in particular not in European government bonds. On the right-hand side, you see the yield of the German Bund. We are roughly at minus 50 bips. This compares to Switzerland with 53 bips, or the same level, if you will. This is unprecedented that both countries have in the government bond yield market the same level. Normally you have 150 basis points difference between them. And you see the stress in the system on the left-hand side. These are the Italian yields, 10-year government bonds, same chart, same length, but the scale is different. So you are at 1.76% minus 50 bips. So there is more than 200 basis point spread between the two countries. The debt to GDP in Italy has reached more than 150%. And some of the rating agencies have already cut the rating for Italy, but there is a risk that we will see soon one cutting it to chunk, and then all institutional money will be forced to sell it, and the lender of last resort is obviously the ECB. The case for China is very controversial. However, if you look at data which cannot be manipulated, like consumer consumption in April are roughly up 1.5% year over year. Amazing. They were down in March significantly. Bank lending is increasing in Q1. Roughly 98% of all large companies are back to work. In the smaller space, we are at 83% roughly, compared to March, where we were at 77%. Last but not least, the Chinese property sector is not booming, but is definitely not collapsing. Prices are roughly up 5% year over year, which I find is also remarkable. Nevertheless, South Korea or China, also Japan, they are different to our society in a way. They implemented the tracking software, systematic testing. So before you go, for instance, working and checking in, you are checked if you have fever. You have always to have your mobile on and Bluetooth data. In case you had contact with a risky person or somebody who got ill, you are immediately forced to go into quarantine. And this has so far prevented to start the second outbreak of the second wave. In some days, there was even no new case in China. And this will be the challenge for Europe. What is amazing is the way the US market is pricing in the future. Every time you see a figure like yesterday, Q1 GDP, it was negative. Everybody knew it was negative. Result, we were looking through. Q2 will be really bad, but nobody cares because Q4 or Q3 will be better. So we had a move up, supported also by the strong liquidity. After the close, for instance, yesterday, Facebook has reported figures. The figures were okay, slightly beating the revised down estimates. The stock was 10% up after the close. The future, the Nasdaq future this morning was up another 1% after having risen 4% yesterday. This is extremely remarkable. It shows that bad news at the moment is good news, and that people are anticipating a strong V-shaped recovery. Nevertheless, another point is this goes up with little liquidity, with little volume, and very concentrated. The 5 largest US stocks are roughly 20% of the S&P 500. This is extremely remarkable. And at the same time, you see here the money market cash holding has risen to levels never seen before, even higher than during 2008. This money needs to be deployed, and I assume it won't go back to the equity market, maybe partially, but most won't. So therefore, it needs to be parked in money market products and maybe in bonds. And some will go to gold and maybe some real assets. But forward looking, you must expect that people will hate the equity rally, and they probably will not participate in the rally we see in the high yield market. Where there are losers, there are winners. Last time we talked about the Russell 2000, it might catch up. And you see on the left-hand side, the Russell over the last 10 days, where the red circle is, has risen dramatically for roughly -30 to -20%. If you put it in this way, it's still underperforming the large US market, but it has really catched up. And you see on the right-hand side that 20% stocks of the Russell 2000 have risen 100% or more, and another 260. So this is 320, or 1/3 of all stocks have risen at least 50%. And this since the beginning of the year.
Andreas, sorry, a quick question to the previous slide. If you could go back exactly. We have here on the right side Russell 1000 stocks, and we see that a lot of these companies which are up 100% are energy, and even more. Most of them are shelf energy producing companies. Noble Energy, Murphy Oil, Apache. We have companies related to oil. Halliburton, Devon Energy, Valero Energy. Is that, maybe you can say some words about that? Is that related to the fact that this sector in the US feels the support of the government and is rising that fast in these connections, or expect an oil rebound, or is it just a coincidence?
No, it's
Thank
not.
You.
Mr. Trump has several times in various variations said, we are going to help the shale gas producer and the energy sector in general. Nothing, to my opinion, has yet been implemented or decided, but all these stocks, and as we come from the bond angle, all these bonds were trading at distressed levels and anticipating possible defaults. And now they are pricing in the hopes that the future will be better, A, and B, that they somehow will be rescued. I mean, there were rumors going around that the US government will pay that you don't drill. This was never confirmed, but on that day, the energy sector went up more than 5% only on the rumor. Therefore, this is not really a surprise on one hand. What is not shown here, obviously, is, actually, this year to date, you see, since the 23rd of March, we are up 100%. However, year to date, if you take the second last from the fourth last, Devon Energy, for instance, is 50%, 53% down year to date, but it is up almost 100% from the low in March. And since then, we have these rumors. So overall, this is not really surprising that this area is outperforming at the moment. But what is also true, there is too much oil production and there's not enough demand. The implemented cut in oil production, which should start in May, is not sufficient. Therefore, further reduction is to be expected. When and how, this is completely open, but this is what is in the card. And I read today an article about oil futures and oil trading, and the guy said he believes that the measurements which were taken have worked because the WTI futures for December has risen, and therefore all the measurements forward-looking are having an effect. Short term, we had the WTI May contract due to, let's call it, inflow into ETNs, and the rollover effect to be for 1 day negative and to close almost at zero. So this is that is a technical angle, but the energy stock is not really a surprise that they are outperforming. And I might add the ones which have survived because some went bankrupt. Europe is, as you can see on the left-hand side, underperforming the world, or here shown as the Euro Stoxx 600 is basically flat. However, Goldman Sachs created a group of stocks which they call granola. Some of the names are not surprisingly in there. So you see Glaxo, Roche, Nestle, Novartis, Novo Nordisk, L'Oreal. I would have expected there, but I never would have expected ASML or LVMH. If you take this group of stocks, they even perform similar year to date than the Nasdaq. One thing is what will happen with all this money to the gold market. Gold cannot be measured, it doesn't pay interest, and you cannot discount cash flows. You can do charts and anecdotal evidence, if you will. And most experts tell us we have consolidated and we will go up to more than 2,000, maybe 2,400 are in the cards. I really don't know because you cannot measure this, but for the first time since a very long time, since the global financial crisis, I strongly recommend to consider, if you don't want to invest into corporates and equities, to add either gold as a hedge or in a leverage way to speculate with gold mining stocks. They are extremely volatile. I mean, we have seen more than 50% in the last 3 weeks, so similar to these small caps before. But if we're really going to see that increase in gold price, that might definitely help, first, to participate, and second, it is probably fair to assume that down the road we will see a digestion or even a collapse of the rising equity market. With that, I come to the conclusion. So it is similar to what we have said 2 weeks ago. You should buy on weakness equities. And fortunately, over the last 2 weeks, we have rather seen only strong markets. Bonds, corporate bonds are extremely interesting, but you have really to do your homework. The balance sheet should be strong, and maybe you look at cash flow projection, the business model, etc. Best value, as said before, is at the moment in US high yields. And if you look at spreads, probably in the BB area, you are best served. We still believe that in certain sectors in China, you get attractive yields for an acceptable risk. Then there is the gold story. Volatility is still high, but less high than before. We were at 80% implied vola in the VIX in the US. Then we dropped to 40, and this morning we were even at 30%. Over the last 10 years, normal was rather 10 to 20%. So there's still some elevated volatility which you might profit from. For portfolio managers, you have really to restructure your portfolio, and you have to see if the fallen angels are still worth buying it or not. If not, obviously you should replace them with other assets. Last but not least, this is not a value call. You cannot make a value case. The US forward-looking PE is around 20, so similar level to before the crisis. And probably the EPS which are underneath are too high. So the market is definitely not cheap. Government bond, you see it in the US, you see it in Germany, you see it in Switzerland. They might go lower. There might be yield control in the US. Nevertheless, Italian government bond yields are rising, and the reason is quite obvious. The debt to GDP is much too high. This announced monetary and fiscal stimulus, and yesterday the announcement of the Fed that they have much more if needed in the wardrobe, is really, really causing a short-term melt-up, at least in US equities. And it supports the outlook to a certain degree, but there are a lot of uncertainties which you cannot really control. So is there a second wave? The answer is probably yes. How big it is, nobody knows. I don't like the sentence, but the conclusion basically is don't fight the Fed. They will really do whatever it takes. And if you were active during the global financial crisis or even during the crisis after the tech bubble burst, they will implement measurements which we cannot foresee and which we haven't seen before. And we are already at levels which are unprecedented, and there might be even more. Are there any questions?
Thank you for the insights, Andreas. Thank you very much. I have from my side 2 questions, and one question is the same I posed to you last time regarding the inflation, but it seems to be very an important question because during the last couple of days I got a lot of requests to comment our view on the inflation in US dollar. So maybe you can refresh your opinion on that, especially in the context of the quantitative easing we see. That's the first question. And the second question I would have is, do you see the rise of new investment, let's say not new investment instruments, but do you see rebalancing towards alternative investments due to this situation in the market? You mentioned gold, which can be seen as alternative investments, but do you see as well the rise of assets such as, let's say, real estate in liquid form, like investments or REITs, or maybe private equity due to the volatile situation on the markets? Thank you.
So let me start with the second question. That's the easier one. On one hand, if we define alternative as well as gold or as REITs, liquid real estate, the answer is in both cases, they dropped in the beginning, gold less than REITs, but both have rebounded. Gold is at the multi-year high. There is not much left to the all-time high we have seen maybe 8-9 years ago, which some strategists or gold experts expect. I tend to agree with it, although I repeat, it is, for me at least, impossible to value gold and to make a real forecast. But I believe that there is demand, be it from investors or be it also physical to store gold. There are in the net kind of these people who are afraid of everything, that they hoard gold, gold in coins, gold in bars. REITs, let me limit the answer to European REITs. I mean, UK REITs were down 70 to 80% and are now up from the low more than 30%. European REITs, in particular in Germany, France, and Spain, were down roughly 30 to 50%. All which are somehow related to residential real estate, they are up. All which are related to hotels, malls, etc., they struggle. What I have seen from the alternative space, I mean, I follow one long-short equity fund. It is down roughly 5%. It's quite an okay job, but they didn't have inflows. I haven't seen really flows or calls from private equity companies. What I do know is that the Partners Group said that they are not deploying the cash they have. They are rather taking care of the existing project and injecting liquidity that the companies and projects they are working on will survive. They see still steady demand for inflows. If I go to your first question, inflation, we have discussed it at length at the C-Bond conference. There is a kind of two time frame answer. So on one hand, if you look at CPIs, PPIs, the official inflation figure, they are disinflating, they are coming down because there's a lockdown, there's less demand. This is quite a kind of obvious. If you look a bit under the surface, and you see, for instance, food. Well, food and energy normally are not included in these indices, but food depends on what and which area, but food is rising because the international chain for traffic of goods is disrupted. And in Germany, for instance, in the cheap supermarkets called Aldi, the fruit and vegetables have risen by 100 to 300%. Of course, if you pay €1 or €5 for apples per kilo or something like that, it's not going to kill you, but it's definitely inflation which is not measured. Midterm, the question is, where will this inflation go to? My assumption is first into asset prices, and maybe in a second round, to a certain degree, into measured inflation. Last but not least, the Fed yesterday said yes, that the PCE inflation indicator they use is going to stay flat or slightly going down over the next 18 to 24 months. So if you look at official figure, inflation at the moment is no problem. There won't be pressure for rising rates from that angle. But if you then look more into details, it gets trickier. And another example, I mean, energy is excluded if you want to buy heating oil at the moment, or if you need to fill the car with gasoline, you see it probably daily that these prices are going slightly down.
Okay, thank you, Andreas. Maybe somebody else has a question from our team.
Yes, Andreas, I have a question for you. And the question would be, we see that many investment banks as well as economists are revising down their GDP estimates right now, and equity markets still on a steady rise. How do you expect this development to continue?
Whew, that's the 1 billion question. I mean, first of all, at the moment, when you publish negative figures or you revise down GDP forecast, market completely ignore that. Second, market really count on government fiscal stimulus and on monetary stimulus. And probably third, the severeness of this lockdown or the impact on GDP is not really 100% implied in the thinking of at least equity investors. Every time you see, at the moment there's earnings season in the US, every time you see a bad figure, but the figure is less bad than expected, stocks go up. It is momentum driven, it's liquidity driven, and the acrom FOMO, fear of missing out, is back. You have seen the cash levels. There is also no selling pressure. Probably everybody who was afraid has sold their equity position, and everybody who bought is probably not going to sell immediately. Although from a technical point of view, it is questionable if we have risen not too far in a too short period of time. But even there, I mean, Goldman Sachs as an example, but there are other investment banks, they revise one day their GDP figure, like you said, but the next day, the US strategist, well-known David Kostin in the market for more than 20 years, has published his path to the near future. We basically expect a retest of the 2,400 level in the S&P 500, followed by a rise to 3,000. I'm amazed that a fundamental analyst tells you exactly the story chartists or technicians tell you since maybe 6 weeks. So for the time being, it's momentum driven. Everybody expects that we will see in the S&P areas of 3,000 to 3,050. Especially after yesterday, we are at the edge of coming out of the resistance level. It is not fundamentally justified. I mean, earnings are not justifying this price. There is another analysis done by Goldman probably 1.5 weeks ago, also in the team of Mr. Costin. They said at that time, before publishing their new target, markets are either 25% too high, markets means the S&P. Now we are actually 30% compared to what they said when it was published. Or the earnings next year should surprise by at least 25% more than what is at the moment in fact sectors estimates. Both is irrational, both won't happen. Therefore, conclusion from Goldman, which I fully agree, it is momentum driven and it might last for a while. But if we do not see a U or V shape, or at least a certain recovery in H2, and in particular in 2021, there will be an ugly wake-up call. But so far, nobody really expects that.
Thank you very much. I mean, I agree with you. For me as well, the most important points are, on the one hand, the very expensive monetary policy, and on the other hand, it's the consequences of the lockdown. And this, in my opinion, is also the biggest risk, because it has the potential to really pose a threat to the market up move as we see it right now, and become a reality check in the future, or let's say maybe even in the near future. But thank you very much. I agree with your assessments.
I mean, if we want to consider history, and I don't say it's similar to what was in the 30s, but in the 30s, after the crash, we have seen rallies like we see now, followed by even more severe downturns. And if the data is not stabilizing, let's put it that way, or at least giving us some hope that in H2 we really see growth, not like before, but at least growth, then we cannot rule out that all these 2,400 testing target will be kind of bad joke and we will go much lower. But for the time being, this is still the main scenario. And it worries me a bit because I have been telling this maybe for 5 weeks. And now I hear a fundamental analyst, which I respect a lot, telling me the same story. I hope he's right, but it worries me because I prefer to be the person who writes, for instance, this most hated bull market is up and running, and I get comments like, you are nuts, everything is expensive, etc., etc. But at the moment, there are more and more investment banks who join the bandwagon, and we will really have to see where this will end.
Thank you.
Thank you very much, Andreas. It was very interesting again to listen to your insights or your expectations also for this week and the coming weeks. Maybe 2 questions for if we take a closer look to Europe. We have seen also that the US, yes, the recovery is going very fast, and you also mentioned today that in Europe this is there are still probably also more risks. You would also not or leave the fingers from European bonds you mentioned, or like European government bonds. So if we take, do you expect that this will widen, like the developments between the US and the European markets? Because if we take a look at Europe, we also have Shell that has fallen sharply today. I mean, the oil sector or energy sector is not yet that baked in the US. We also have the unsolved problems with airlines. They are also less backed than probably in the US at that stage. What do you expect here?
Let me try to share with you a screen. I mean, the answer to your question is if I look just at the index level, I would expect the gap to widen. And the reason, I think I've shown this before, is that the expected EPS growth or rather slowdown will take until 2023 to reach the pre-crisis level. In the US, this looks a bit better. But as you mentioned, the example of Shell, and I showed today this one, the truth is in the pudding or in the detail, if you will. There are in Europe companies which are interesting and do perform well. What we miss in Europe is the Fund Plus sector. I mean, you have SAP, you have ASML, but then sooner or later it stops giving me really larger scale companies in that angle. We have, however, defensive sectors in Switzerland, obviously Nestle, but also L'Oreal, which actually is part of Nestle because they are invested in it. We have some healthcare, which looks good. If the oil market is recovering, and today, at least when I looked last time, the oil was up, I would expect Shell, BP, and all the others who are in Europe based, also Repsol as an example, to profit from it. But as a whole, the European area, maybe excluding Switzerland because of the constituents of the index is probably going to underperform. But I must also say I'm surprised by the action of the ECB, A, and B, although the European governments are quarreling how to help, the announced program of 1.5 trillion euros is tremendous. In the end, we have Italy, which debt to GDP is 153, I read today, and will go up further. And now it comes to the point, if I'm a serious portfolio manager, would I buy BTB bonds? Probably not. If, however, I speculate that the Italian state cannot go bankrupt, and most likely somehow there will be a rescue if that would happen, or if you ask people from Italy, professionals, they probably will tell you, well, I get 1.7%. Yes, the rating is almost in high yield, but it is still the state who guarantees. And if not, the ECB is going to buy the bonds. So it is a tricky one. And I would say there's always, in all areas, opportunities. But if I look just at the index levels, knowing that this is in Europe a bit controversial, but I learned that at Goldman, and it took me really 3 years to swallow it, but since then I believe in it. Given what the Fed has announced, what the US government has announced, knowing that the US market is too expensive, I still believe if you want to deploy money, you should start with the US, because there you have a safety net which is unprecedented. And then once you have, for dollar investors at least, a base investment, then you can consider others.
Thank you very much. And as you mentioned again, the Italian bonds now as well, and you mentioned in your presentation that if they are like considered junk, then they will be rebalancing from large institutional investors. So the money then probably will be rebalanced to like government bonds from France or Germany. What kind of developments would we expect there?
Well, on here again, you see the 10-year yield of the Italian bond, and you see since the ECB is talking, we have seen a drop in yields from more than 2% to below 1.8%. If they cut it to chunk, and this is unfortunately, I would say at least to 60% likely that this will happen. The ECB already said we will buy them. And on the other hand, the money will flow into Netherlands bonds, into bonds, probably France, probably Spain, although Spain is also at elevated levels. And that will dampen, given demand and supply, the effect on the yield. So you will have even capital gains. The question is if this tremendous buying program will contain this yield in Italy below 2% for the time being. It looks like, but it really depends how fast Italy can restart producing. They are reopening, like Germany, but obviously they were hit much harder, and the real effect is not yet known to us. And I fear that we will get a bad wake-up call once real figures and enterprises will report data.
Okay, thank you very much.
Andreas, thank you very much also for your presentation. It is, as always, very interesting and informative. I have one question to the slide about the tremendous amount of cash available on the market. So how do you see how these funds will be allocated? We have seen recently a bond program buying bonds with a certain rating. Do you think it will continue in this way? Which asset classes will benefit from this cash, and who is going to decide on this? It is banks, is it Fed, or what is the rule or constraints behind this?
I assume you refer to this
Exactly.
this slide. I mean, this is or are aggregated deployed money to different asset classes. And if history is any guide, I would expect that the money will not flow mainly to equity. It will be very modest since the great financial recession. We have seen rather outflows on equities, although we have seen rising markets. We have seen tremendous inflow into bonds, mainly investment grade, but to a certain degree also high yield. Corporates definitely. And the cash amount has risen and risen. I would say if one can offer alternatives to invest cash into a cash-like product, this kind of, let's call it solutions, are definitely preferred. But it is really difficult. I mean, you have pension funds, they have their strategic asset allocation, they will rebalance. You have insurance with as well a strategic asset allocation. They will also, if needed, rebalance, but normally they have already matched their asset and liabilities. So in the end, you have the retail flow left, and the retail flow is the damp money, and the damp money to a certain degree has never really come back to markets, or at least to risky assets like equities, like REITs. I don't know if that answers your question.
Yeah, thank you.
Okay, we have now exactly 1 hour since we have the meeting, and I think it's time to close it down unless somebody has an important question to ask. If not, I would like to say thank you to our CIO, Blackfort CIO Andreas Bickel, for your macro analysis, for everybody who participated, managing partner and co-founder Oleg Falikovic, specialist in equity Simon Meyer, head business development in Europe Ivan Gerber, and head business development Eastern Europe Arseny Volinov. Thank you very much for joining. And for everybody, this is the recorded video of our conference on the April 30th, and you will get also if you subscribe, you will get our macro analysis in hard copy, and I mean in a soft copy, but in a text version. We'll distribute it in the beginning of next week. There we will see the synopsis of today's talks and discussions in written form. Thank you very much, and join us in 2 weeks again. Around the 15th of May, we will have another Market Watch after the holidays. Thank you for everybody.